In the fourth quarter of its fiscal 2026, the publishing business at ValueLine earned $19,000. Not $19 million, $19,000. For the full year, the company that has published the ValueLine Investment Survey since 1931 made 13.7% of its pre-tax income from publishing research. Earnings per share went up anyway. Pre-tax income was $29.4 million. Publishing operating income accounted for $4.0 million of it. A non-voting revenues interest in an asset manager called EAM brought in $16.6 million. A non-voting profits interest in the same manager, another $2.3. And investment gains on the securities portfolio, $6.4. 2 years ago, publishing was 36.3% of the total. Today, it is 13.7%. So what is that interest? In 2010, ValueLine spun its fund business into a Delaware trust and kept no votes and no board seats. What it kept was 2 contractual claims: a revenues interest, a share of the manager's fees on a sliding scale from 41 to 55%, paid ahead of that manager's own costs and ahead of its operators' profits, and a profits interest in half of what is left. The filing calls the first one a preferred interest, carrying less risk than the stakes held by the people who actually run the firm. Meanwhile, the operating line has fallen 3 straight years. $11.5 million in fiscal 2023, then 9.1, then 6.0, then 4.0, down 64.9% in 3 years. Operating margin went with it, from 24.4% to 12.1%. The fourth quarter makes it concrete. Publishing earned $19,000 of operating income in the 3 months to April 30th, against $7.99 million of operating expenses in the same quarter. 3 years earlier, that quarter produced $2.76 million. Revenue has fallen 3 straight years to $33.4 million from $37.5 million. But look at which line moved. Print is down 9% over 2 years. Digital down 4.5%. Copyright fees, the licensing income from fund sponsors who use the ValueLine ranks, are down 20.5%. That one line is 61% of the entire decline. 2 obvious defenses do not survive the filing. First, this is not a mix shift out of print into digital. Print fell 3.8%, digital fell 3.1%, and digital circulation rose 0.8% while its revenue fell. So price and mix went backwards. Second, the 1.1% rise in operating expenses is not cost indiscipline. The whole increase is office and administration, $460,000 of it spent on a fulfillment upgrade, a new e-commerce platform, and accessibility compliance. Advertising and salaries both fell. And here is the problem with treating the passive income as the safe part. Assets under management at the ValueLine funds ended the year at $3.72 billion, down 20.4%. Redemptions nearly doubled to $1.91 billion, while sales fell 44%. The core bond fund was liquidated in November. The cash flow statement puts it plainly. ValueLine received $19.56 million of cash from the manager during the year. Total cash from operating activities for the entire company was $18.58 million. The distributions from a business it does not control were larger than every dollar of operating cash flow it generated. Split the $2.30 of earnings per share by source, taxing each piece at the same 26.5% rate. Publishing contributes about 32 cents. The manager interests contribute $1.48. Investment gains contribute 50 cents. A shareholder reading only the earnings line sees $2.30, up for the 3rd year running. 14 cents on the dollar of it is the research business. What is it worth as a set of parts? Hold the securities portfolio at its fair value of $86 million. Capitalize the after-tax manager stream at 7, 9, and 12 times. and after-tax publishing income at 8, 10, and 12. Deduct the $14 million deferred tax liability. Bear case, near $17 a share. Base, near 24. Bull, near 31. The stock traded at $36.50, above all three, which says the market is capitalizing that claim higher, paying for the scarcity of an 8% float, or pricing the buyout option value line holds over the manager's voting interests. Implied value under stated assumptions, not a price target. Value line is profitable, carries no debt, raised its dividend again, and holds $86 million of securities. None of that is in question. But the dividend it paid this year, $12.2 million, was 3 times what the publishing operation earned. The publishing decline is slow and partly self-inflicted. The decline in fund assets is fast and outside the company's control. One more thing. Artificial intelligence is named 5 times in this 10K. Every one of them in the commentary on the American economy, and 0 times in the risk factors. Nobody wrote this by hand. Every number came out of Value Line's own XBRL, the machine-readable filing the SEC requires from every registrant. Value Line's 10K went through the same pipeline as any other filers, and a private company reporting in the same format is the same job. This entire analysis was built on the RoboSystems SEC shared repository, structured filing data for every public company that files. Revenue, earnings, balance sheet, cash flow, all queryable, all from the original XBRL. The link is in the description.